Hello and welcome to the Moneycontrol Live. I'm Karunya Rao. Indian markets spiraled this morning. Russia's Vladimir Putin announced a military operation in Ukraine. A precipitous market drop induces panic typically, and that's what happened today. Indian markets were among the worst hit among Asian peers. In fact, the market cap of BSE companies was slashed by more than $100 billion in the very first hour of trade. Meanwhile, oil prices hit $100 for the first time since 2014. Gold prices climbed as well. So let's address the big question. How should you manage your investments at a time like this? And to help us with that, we have Pankaj Murarka of Renaissance Investment Managers and my colleague from Moneycontrol, Manisha Gupta. Hi guys, thank you so much for touching base. Pankaj, I'll start with you first. Markets were already reeling under several headwinds coming in. Relentless FII selling, expectation of interest rate hike, high fuel prices, rising inflation, and now, of course, this, which is perhaps the worst possible news that the world has seen in the last many decades. Clearly, it has hit the sentiment in a big way. What would be your advice to investors? How should they combat market impulses of, panic selling that's taking place across the various pockets in the market?
Well, good afternoon, Karunya. I think, it's a tricky situation in terms of what's happening out geopolitically between Russia and Ukraine. But having said that, purely focusing on markets and wearing a hat of a capitalist, I firmly believe, if we analyze the situation, it does not have a direct, meaningful impact on India and Indian economy. Except for that, the rising oil prices does hurt us because we are a big oil importer. But the fact remains that the prospect for Indian economy remains strong. We're coming out of 2 years of COVID-driven lockdowns and unlocks. And I think the outlook for Indian economy remains very resilient going into the next year. And I don't think so that changes materially because of this. So my advice to investors would be to not to get too perturbed by this volatility. And in fact, I would rather advise that they should use this volatility or sell off to their advantage and probably use it as an opportunity to make some investments into some high quality growth companies from a slightly more medium term to longer term perspective. Often we observe that situations like this or crises like this, when there's significant panic in the market or where there's blood in the street, are some of the best times to invest into when we look at it, historically. And I think once things settle down geopolitically, probably over the next week or 10 days, and when we look back on this, probably we'll also realize that this was one of the best time to invest into Indian equities. So I would sincerely urge investors to use this as an opportunity and make some investments from a medium-term perspective and not get too perturbed by short-term volatility.
Well, this volatility has been lasting for quite some time now, but you're telling investors to shift focus from stock prices to perhaps the way several businesses are functioning and their fundamentals as well. How do you go and look for value when across the board there's so much of selling happening, whether it's blue chip companies, whether it's penny stocks, some of these small and mid cap names which had really run up in the last couple of years? How do you find value?
Well, that's not so difficult, Karunya. I think, as the classical saying goes, that you should buy when there's blood on the street. And I think today was one such day where 95% of the stocks were actually down, and there was clear cut, very deep cuts into a lot of stock prices. These are some very short-term reactions of the markets to the geopolitical events. But for a lot of these good companies, this does not change their long-term fundamentals. So I think which is where the gap between price and value emerges. And I think if you look at some of the great companies, all of them were down, let's say, between 5 to 10% today as well in a single day. So I would say investors should look at some of the large companies, avoid small caps or mid caps at this point of time, and look at good quality companies. So, for example, we are positive on banks. Within banks, we like private sector banks, and ICICI Bank and HDFC banks are the ones which we like. Likewise, we are positive on the outlook for Indian economy, and as a result, we are positive on Indian autos going into the next year. So some of the leading auto companies had a very deep cut today. I think crises like this are good opportunities to invest into some of these companies because these are some of the leading companies in India from a 2 to 3 years perspective. And I think once we get over this crisis, I'm very sure that stock prices will rebound strongly.
Any pockets in the market where you have a complete avoid at the moment?
Well, we are avoiding companies which are very expensively valued. So there's a pocket of market where, especially consumer staples and some of the newly listed internet companies which are making huge losses and still continue to trade at exorbitant valuations, or their companies in consumer staples which trade at multiples which are like 50, 60, 80 times their earnings. So we're avoiding that pocket of the market where P's are extremely high. But apart from that, there's nothing much that we're avoiding, because our view on the Indian economy going into next year, over the next few years, remain fairly positive. We think Indian economy will show a very strong rebound going into the next year. So we remain by and large positive in most of the sectors.
So let's just say that people who missed the bus back in 2020, when the market started picking up from massive lows. If somebody missed that bus, and right now the market is presenting another opportunity to dip in, how would you park your money across various assets, whether it's mutual funds, direct equity, gold perhaps? I mean, how would you recommend that new investors start their journey or restart their journey right now?
As far as new investors are concerned, I think they should have if they're fresh starting into equities, I think they should, I would rather advise them they should take the mutual fund route and not venture into stocks directly, because through a mutual fund, you can buy a portfolio of stocks, maybe 40, 50 stocks, so which will ensure there is a fair degree of diversification in your equity allocation. And more importantly, I would advise them to have a fair degree of balance in their portfolio and not go 100% into equities to begin with, and probably have a right balance between fixed income and equities within their portfolio. I'm not a big fan of gold over a longer period of time, because it's an asset which does not yield you anything. And I think in a high growth economy like India, where the nominal growth of the economy over a longer period of time is double digits, and corporate profits are still, despite all the crises, are growing at 12, 13%. Investors will be far better off investing into growth asset like equities rather than investing into dead assets like gold, which could be a short-term, which could preserve your value in times of crisis like this, where prices could be stable. But from a longer-term perspective, I don't think so. Gold can give returns which can be anywhere closer to equities. So I firmly believe that equities will outperform every other asset class, and investors should have exposure to equities. I've been saying this for the last 25 years, right from '96 when I started my career. People believe that equities is risk, but I firmly believe that not investing into equities is a much bigger risk, because if you don't invest into equities, then there's no the asset class which can give you that kind of return that equities can give over a longer period of time. So it's very important that investors should have adequate exposure in their portfolio to equities. And for fresh investors who are just beginning their journey, I would advise them, strongly urge them to go to the mutual fund route.
Talking about asset classes, one segment that was fast gaining traction over the last 1-2 years is cryptocurrency. And given the way the geopolitical crisis has played out, gold on one hand has soared, oil has soared, but crypto has crashed. So what is the investing lesson here for new traders, especially those who are betting big on cryptos?
Well, to my mind, crypto, while it has emerged as an asset class over the last, let's say, 7-8 years, but I still think that's a speculative asset class, because it's an asset class which is not central in portfolio allocations. Though I see a long-term logic for existence of cryptos, given the fact that central banks have gone overboard over the last 15 years in terms of expanding their balance sheets, and their concerns, longer-term concerns about debasing of currencies, which has been happening for a very long time. But yet, I think it's an asset class which is extremely speculative. So and I don't think so. It's meant for investors with a medium-term to longer-term perspective, because it's an extremely speculative asset class. When asset class moves, it falls by like 70-80%. Then obviously, and there's no underlying value to crypto. It's supposed to be a proxy to a currency. So anything which is proxy to a currency has to have a more stable value, rather than having wild swinging values like what we've seen in most of the crypto assets. So I think it will still be a very long time before crypto stabilizes and becomes a central asset class. So I would urge investors not to pay too much of attention to it and just ignore that.
All right, Mr. Pankaj, thank you so much for joining in and sharing your insights on the market. And talking about alternate assets and commodities, we have Manisha here with us. I'm sure you're having a field day today. Crude is beyond 100 after so many years now. What lies ahead? I mean, markets clearly are spooked by the tension, but I think what's worrying people more is the shooting prices of oil.
Well, absolutely. And, Karunya, there are three ways of looking at what the crude prices are doing right now. One clearly is that you have to understand that it's a phase. Remember, in last many years, we've seen crude oil prices at all-time highs of $147 per barrel. And then do not forget about 2020. We saw minus $37 per barrel as well. So, yes, that is exactly what crude does to you. And when you look at various reports and the kind of sentiment that's floating around, the expectation is that this conflict between Russia and Ukraine could last another 2 weeks or 10 days, and that's exactly the time that you will see the crude oil prices continue to spiking as well. We almost are at $105 a barrel right now, and yes, there are those forecasts floating around that it could be getting to 115, 120, 125, 130, take your pick. I mean, that's exactly what the Wall Street banks are telling you right now. But the other point really is that US is headed for its midterm elections this year, and even as we continue to talk about the kind of inflation that there is, 40-year highs, half of that inflation clearly comes in from crude directly. And they would not want crude prices at these higher levels. So yes, we would be looking at correction sometime in the month of April or May by the middle of this year. But the third most important point is for the Indian markets itself. 80% of our imports are crude. Dependence is clearly high there. And also the fact that since 1st of December, we haven't hiked or moved our petrol and diesel prices. And that would perhaps happen after 10th of March. That is when the election results would be out as well. What kind of adjustments are we looking at that time?
More bad news.
Yeah, but then again, history tells us that never at a time have we seen 8 to 10 rupees of a surge. If you calculate it right now, that's exactly what we're looking at. 10 rupees of a surge in petrol and diesel, and that has never happened. It always happens in phases. So it's going to be very interesting on where we stand in middle of March. I think that is where the pain would really come in from.
All the indications are to go green then.
Oh, yes, there are.
Well, but crude is not the only one making the headlines today. Across the commodities basket, all the metals, especially the precious metal gold. And you were telling me a couple of days back, it's a good time to invest in gold. How much richer have people gotten with gold?
Oh, plenty.
What have I missed?
You have missed $45 of pure gain in last 24 hours. I mean, that's the kind of run-up that we have seen. And I get Pankaj's idea that you can't be an investor or you can't hold gold too much, but then you can't invest into equities 100%, right? A diversified portfolio exactly means that you have to have gold within that. And we started this year with $1,800 per ounce. We're standing at $1,960 per ounce right now. So it has been a clear $160 of a jump up. And if 2020 was any year, any education, we've seen $2,058 of an all-time highs. So we are basically $100 away from those kind of levels. Not too far away, and yes, we can get there, because even as the conflict between Russia and Ukraine will go away, we still are staring at very high inflation, and that would be supportive for gold prices going forward.
But I want to circle back to oil once again. 80% of our imports are dependent on oil. What are these companies in the listed space specifically which are stand to lose from this or stand to be impacted by this? Because a lot of our viewers are not essentially interested in commodities, but also in the markets. So which are the stocks that they should be looking at?
I think all the oil marketing companies, they are under huge stress right now. And what we understand, as there has been conversation with them, is that they are losing 10 rupees per litre from where we stand right now. So it is a very stressed balance sheet. It is not looking good. And it is not for too long that they will be able to take these kind of losses. So I think, yeah, as I said, come mid-March, and we will have to let some of these being passed to customers. So yes, you need to support, the government perhaps will need to support these oil marketing companies and IOC, BPCL, HPCL, etc. And then of course, I think it's going to be by mid of March is when you will see a support, a rebound coming in for many of these.
What about other metals? Because I mean, no matter where you look, they're all firing away.
Absolutely. Oh, Karunya, it is great time to be in pure play, not so much in the metal companies for that matter, but the best of the returns really has come in for aluminum and aluminum companies. So whether it has been Nalco, Hindalco, Vedanta, they are pure plays again in case of aluminum. And we have seen 42% of gains in aluminum in last year. It's up by 26% now in this year. It's trading at an all-time highs. So aluminum clearly has run through the roof. The other metal that you have to look at is nickel. Again, 10% of global nickel comes in from Russia, and we are looking at nickel prices trading at a 10-year highs. It has been higher highs that we've seen in nickel as well. But then for India, there's not clear, sure, straight play for nickel because we import much of our nickel. So when you want to play nickel, you have to do it either via iron ore or steel. It has to be a proxy play in sense of companies there.
I don't want to let you go without asking about cryptos because I know you track that space very closely. But given the way they've come down crashing, a lot of traders who just wanted to get on the bandwagon and invest and trade in the world of cryptos are now really stumped and they don't know what to do. What are you hearing from the street and from people who the big voices in the crypto world?
So I want to tell you about the price view here as well. 2 years ago, we were at $8,000 for Bitcoin.
Right.
We saw it go to 64,000. It's trading at 37,000 right now. So this is 2 years of what crypto has done. Let's not even start on how it began at 80 cents. People who bought it back in 2013, etc. So yes, India has its crypto millionaires. We have seen a huge amount of volatility come in here. But let me also tell you that come end of March, because that tax hits from 1st of April, come end of March, you will see a huge amount of sell-off come in from crypto before people get into that 1st of April, before they actually have to give profits or other taxes on those profits as well. So last week of March is going to be very interesting for crypto. And even as we do keep talking about on the number of people that hold cryptos, but it is really a handful of people who hold huge amount of cryptos. And yes, it would be very interesting.
So in the run-up to 31st March, there will be a lot of oscillation, right? Because people will buy, sell, and make whatever they can before the tax hits.
But the point I'm coming is that the amount of crypto that gets sold just to ensure that you don't have to get into that rather tax net on 1st of April, that number is huge. And I've been talking to some of the international guys as well. They said this is a time we will come to know on how much India actually holds and how much are they willing to take profits on or not pay taxes on.
Absolutely. Interesting times ahead for the world of crypto and the traders who are interested in crypto. Thank you so much, Manisha, for joining in, and thank you to all our viewers as well for tuning in. We'll keep getting you more insights, more well-rounded insights on all the various aspects of market, various asset classes. So keep it with Money Control. Thank you for tuning in for this show.